By early 2026, the global gold market hit a state of frenzy, with the price of a single ounce shattering every previous record in the entire history of modern finance. In 2025 alone, gold prices climbed 65% to deliver the asset's best annual performance since 1979. The first quarter of 2026, the momentum accelerated, pushing the price past the $5,000 threshold. Central banks are usually the primary force behind this demand, collectively hoarding more than 1,000 tons of gold annually. This aggressive accumulation represents a global push toward de-dollarization, the strategic effort by nations to reduce their reliance on the US dollar as a reserve currency. These massive institutional figures create a media vacuum. The resulting coverage often leaves ordinary investors in a state of FOMO, wondering if they are late to the only profitable trade left on the board. However, a different school of thought suggests this rush is purely speculative. Traditional investors often view the surge not as a flight to safety, but as a classic price bubble driven by psychological panic. Warren Buffett has long been the most vocal critic of this gold perspective. He famously describes gold as an unproductive asset, a slab of metal that simply sits in a vault without the capacity to create new value. This complete lack of production creates a massive opportunity cost. Unlike a portfolio of equities, gold provides no yield, pays no dividends, and has no internal earnings engine to drive compounding growth over time. This leaves the average investor with a difficult choice. Follow the narrative of the hoarders or adopt the total dismissiveness of the traditional investor. To resolve the conflict, we look at the 50-year track record that began in 1971. This was the year of the Nixon Shock, when the US dollar was officially unpegged from gold, allowing the metal to trade as a free market asset for the first time. The data from 1980 to 2000 validates the critics. During those 2 decades, the stock market experienced a historic boom. While the price of gold plunged 70% in a brutal multi-decade bear market, yet the period from 2001 to 2011 supports the opposing camp. Gold prices surged 600% as the asset served its role as a safe haven during the dot-com crash, the unforgettable September 11th, and the global financial crisis. This brings us to the current bull run. Like the 1970s and the early 2000s, this cycle is being sustained by high inflation and a breakdown in geopolitical stability. History shows that gold is generally a poor performer during equity bull markets, but thrives in periods of crisis, because predicting the exact start of the next economic era is nearly impossible. Attempting to time these cycles is rarely a successful strategy. Institutional analysts tend to ignore the emotional debate to focus on risk-adjusted returns. This metric measures how much profit an investment generates relative to the amount of volatility and price swings an investor has to endure to get it. Research from the World Gold Council and State Street indicates that 2 to 5 to 10% allocation improves returns while lowering maximum drawdowns. Further 50-year studies from VanEck and Flexible Plan Investments show portfolios with up to 18% gold continue to outperform a standard 60-40 portfolio. These figures have led major firms like Morgan Stanley to suggest a 60-20-20 framework. This model splits the traditional safe portion of a portfolio equally between bonds and gold, reflecting a growing belief that bonds alone may no longer provide sufficient protection against persistent inflation. Within these specific percentage limits, gold functions as a volatility dampener. It uses its low correlation to other assets to help stabilize the total value of a portfolio across different economic environments. Adopting a 5 to 10% allocation is the first step, but the actual challenge is surviving the asset's price swings. Even in a bull market, gold remains notoriously volatile. In January 2026, the price fell 9.8% in a single day. For an investor who bought in at the peak, that kind of sudden drop often triggers a panic sell that locks in permanent losses. To neutralize this risk, professional strategies rely on dollar cost averaging. This involves investing a fixed dollar amount into the asset at regular scheduled intervals, regardless of what the current price happens to be. You can do this by directing 5 to 10% of your monthly contributions into a physical gold ETF, a fund within vaults of gold that trades on the stock market. This ensures that you are not trying to time the market, and you can even automate the process. You remove the emotional pressure of buying based off of the price. When you follow a strict plan, gold stops being a speculative lottery ticket and becomes a functional form of insurance for your wealth. You don't need complexity to build wealth. You just need a simple structure, discipline, and time. Hey, I'm Orla. If you like this video, drop me a comment, like, share with a friend, and of course, follow along if you want to see more.